Welcome to The Explainer. Today we're going to decode the secret language of the financial markets. We're going to take what looks like, pure chaos on a chart and learn how to actually read it, like a story all about the psychology of money. Okay, so when you first look at a stock chart, right, it just looks like a bunch of random, unpredictable squiggles. But what if? What if there were actual stories hidden inside all those peaks and valleys? And more importantly, what if you could learn how to read them? So how do we even start to do that? Well, it all begins with this core idea that turns all that chaos into actual clues. It's something called pattern theory. So what this theory is really saying is that these patterns, they're not just random noise on a screen. Nope. They're actually a visual representation of this constant battle, this tug of war between optimism in the market, the buyers pushing prices up, and pessimism, the sellers pulling them right back down. Every single shape tells a part of that story. And these stories, they usually fall into a few key categories. We're going to break down the most common ones you'll run into, starting with, honestly, the most fundamental battleground of them all, the triangle. All right, so triangle patterns, think of these as a picture of a market that's, it's stuck. It's in conflict. This is where the tension between the buyers, we call them the bulls, and the sellers, the bears, is just coiling up tighter and tighter, kind of like a spring, right before a huge decisive move. Okay, first up, let's look at the ascending triangle. This is a classic bullish or optimistic pattern. You can see the theory on the left and then a real-world example right there on the right. Now notice what's happening. The sellers are holding this firm line up top. That's what we call resistance. But the buyers, they're getting more and more aggressive, pushing the price floor higher and higher every single time it dips. And this really gets to the heart of the psychology of what's going on. The idea is that even though the price isn't breaking out just yet, the buyers are quietly, secretly gaining the upper hand. Every time there's a dip, they jump in a little bit sooner, and that signals this growing confidence. They are just relentlessly building pressure on that ceiling of resistance. So here's the key takeaway, the really crucial point. For this pattern to be legit, a breakout to the upside is what you expect to see. It's the most probable outcome. And for that breakout to be truly reliable, you really want to see a big spike in trading volume. That's the confirmation. That's the signal that the buyers have officially won the battle. Okay, now let's completely flip that on its head and look at the descending triangle. It's the exact mirror opposite. This time you've got a level of support at the bottom where buyers keep stepping in to prop up the price. But look at the top. The sellers are the ones getting more aggressive now, pushing the price down further and further with each little rally. The highs just keep getting lower. So yeah, this pattern tells the complete opposite story. It's a story of growing pessimism, of growing fear. It suggests that the sellers are the ones taking control now, applying more and more pressure on that floor of support. You can almost feel the cracks starting to form, can't you? It's hinting that that floor might be just about to break. And here's a great way to see it, to two psychologies right next to each other. The ascending triangle shows that growing confidence, and it's probably going to break up. The descending triangle, that's growing fear, and it's probably going to break down. In both cases, one side is slowly but surely winning that psychological war. All right, let's move on. Let's see how this builds with our next pattern. So what happens when a really strong trend, doesn't matter if it's up or down, just needs to catch its breath for a minute? Well, that's where we get something called the flag pattern. Yeah, the best way to think about a flag pattern is like a quick pause or maybe a pit stop during a big race. The market just made a huge, fast move. That's what we call the flagpole. And now it's just consolidating, kind of catching its breath inside that little rectangle. That's the flag. Before, you guessed it, probably continuing in the exact same direction. So here's a perfect example, a bull flag. See that strong upward move? That's the flagpole. And then the price just kind of trades sideways, maybe drifts down a little bit. For a lot of traders, this little consolidation period is seen as a really strategic time to get in before the next leg of the rally kicks off. And on the flip side, in a downtrend, you get a bear flag. It's the same idea. After a sharp drop, the price might bounce a little or just trade sideways. But this pattern is a strong suggestion that this pause is only temporary and that the downward momentum is very likely to start up again. Okay, let's dive into some patterns that show the market really getting squeezed into a corner. These shapes are all about momentum, either fading away or building up in a super tight range, basically forcing a decision one way or the other. So a wedge, it looks a little bit like a triangle, right? But There is a super important difference. As you can see, both the boundary lines, the highs and the lows, are moving in the same direction. They're both sloping either up or down, but they're squeezing together. This convergence is a huge signal that the trend is just getting tired, it's losing steam, and it's often a warning that a price reversal could be just around the corner. And then we have the box pattern, or sometimes people just call it a range. Honestly, this is one of the simplest patterns to spot. The price is just stuck. It's bouncing back and forth between a clear floor, that's our support, and a clear ceiling, the resistance. The market is just in a holding pattern, waiting for some new information, some catalyst, to finally break it out in either direction. Okay, so we've looked at all these really fascinating patterns, but what's the point? How do traders actually use them to make decisions? Well, it all comes down to one critical moment, the breakout. It really doesn't matter what the shape is, a triangle, a flag, a box, whatever. The single most important signal is that breakout. This is that moment of truth, when the price finally breaks free from the pattern's boundaries, and it signals that one side, the bulls or the bears, has decisively won the battle. And the analysis here points to two main ways you can play this. The first is the aggressive approach. You jump in right as the breakout happens. But there's a more conservative strategy, and that's waiting for what's called a retest. This is where the price actually comes back down to touch the boundary it just broke through, to kind of test it, to confirm that it has flipped roles. So old resistance becomes new support, or old support becomes new resistance. For a lot of people, this retest is considered the optimal entry point. So, if there's one thing you take away from all this, let it be this. Chart patterns are not crystal balls. They're not magic. They don't predict the future with 100% certainty. What they are incredibly powerful tools for understanding the psychology of the market and for figuring out the probabilities, what is likely to happen, not what is guaranteed to happen. It's all about playing the odds. And all of this leaves us with a really fascinating final question to chew on. Are we just observing patterns of human behavior that are already happening in these charts? Or, because so many traders are looking for these exact same patterns, do the patterns themselves actually become a kind of self-fulfilling prophecy, influencing how we all behave in the market? Something to think about.